Hello, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this video, I'm going to take a look at the dividend aristocrat, Stanley Black & Decker. I actually consider this a real great example of a dividend growth stock more than I do a dividend yield stock. So let's start by looking at the company's earnings to explain what I mean. The orange line on here is the PE ratio of 15 times each year's earnings listed at the bottom of the graph. Now, it's a growth stock because earnings have gone from $2.06 to an estimate of $8.41 by this fiscal year ending in December. Now, there has been some, I'll call it very modest cyclicality along the way here. You can see that during the Great Recession, we had a couple of down years in earnings here. But then subsequent to the recession, we saw a period of time of really great growth, and I'll be talking about that more. But one thing I really like about this particular dividend aristocrat is that the price and earnings correlation is very, very profound. So now I'm going to add monthly closing stock prices to the graph. And I want you to see that stock price tracked earnings that are at more or less a 15 PE ratio for all these years. And then, as I mentioned in the written portion, really in 2015, the price really got disconnected or above the orange line. And it stayed that way coming into this fiscal year, which ends, by the way, in December. And then we had this 20% correction that I alluded to, which now brings the company closer to fair value than it's been in the last couple of years. Now, since it is a dividend aristocrat, let's plot dividends and the dividend payout ratio. It is a dividend growth stock also because the dividend has increased each and every year, as you can see. Now, the current yield is 1.9%. It currently trades at a PE of 17.1. That's a blended PE, which is slightly higher than the 15 represented by the orange line. But if I look at performance of this stock, a $10,000 investment on December 31st, 1998 would have thrown off $10,151 in dividends, roughly twice what the S&P or an equal investment in the S&P would have paid off. It also turned $10,000 into $48,000 of capital appreciation, or increased almost fivefold. Now you add in the 10,000 dividends and you see that you have almost a 6-to-1 investment here. Investment in Stanley Black & Decker, a long-term investment, would have increased your initial investment by almost sixfold. That's without reinvesting dividends, to 9.5% compared to the S&P of 6.2%. So it's more of a capital appreciation investment. But I also want to point out this is also being measured after we've had this correction. I mentioned in the written portion we had about a 20% correction so far this year. And that's, from the beginning of fiscal year 2018 to current. And we're getting closer to fair value. Now, the dividends have been paid out, and you see that by the light green line here, but I do want to show you something. If I look at the earnings growth rate of 9.1% over this time frame, that includes these down years we had here. So if I shorten this time frame to where I go just past the Great Recession, past 2009, all of a sudden we see that the operating earnings growth has now averaged 13%, or significantly higher than we saw with the previous year. But I do have one anomalous growth year, and that's the year coming out of the Great Recession, which was a down year. So we had a 21% drop and then a recovery, and that's more of a reversion to the mean. In other words, if I drew a line from this triangle to this triangle, it's more of the earnings going back to their more normal levels. But if I take that year out again, we see that we had this 13% level. But I want to drop it again. I want to get more normal here and take that 54% growth rate, and we're back to about a 9.7 to 10% growth rate. So Stanley Black & Decker has accelerated their growth. Now, during this time frame, I want you to notice that the blue line here, it represents a PE of 16.8, or it's the normal PE that the market has valued this stock at since 2011. And again, as I change time frames, that normal PE adjusts, but it stays around that 16 level. I want you to notice. Here we have 15.8. So when I'm down here to these last several years that I showed you a minute ago, we've got a 16.8. That might be a little on the high side, but the point is the stock would be trading back to that normal valuation, and that makes it attractive for the first time in about 2 or 3 years, which is one reason I particularly, decided to cover this particular stock. Now, another way to value a stock is, again, look at year-end dividend yields. And I'm going to go ahead and expand this back out to the long-term graph. And I do want you to notice that last year, at the end of last year, their dividend yield was 1.4%. That's when the stock was priced at 169. Well, the price has since fallen to 135 3/4, if you will. and that brings the dividend yield up to 1.9%, which is, roughly what it was a couple of years ago. So we now have a decent dividend yield. The highest dividend yield this stock has offered was a 3.7% dividend yield in December of 2008, and that was during the throes of the Great Recession. And remember, this is a dividend aristocrat. They've increased their dividend for 50 consecutive years. So even though earnings were down and stock price followed that drop in earnings, I want you to notice, the PE got down to under 10, and as a result, you ended up with a dividend yield that was exceptionally high, almost 4% during that time frame. But even holding it to this recent correction, you'd have averaged over 18% a year. And this is the importance of valuation and how valuation really impacts your investment decision. But the other thing I want you to see here is that how the price and earnings have tracked each other. The point is, the business generates your rate of return when valuation is properly aligned. Since it is a dividend aristocrat, let's take a look at operating cash flow real quick, because I like to look at a stock from all these different alternatives. From an operating cash flow point of view, I'm not really so concerned about valuing it relative to its price. So I'm going to take these valuation models off. What I'm really looking at is the operating cash flow covering the dividend. And you can see that their payout ratio of operating cash flow in recent years has been around 25, 22%, 27%, but it's historically averaged about 25% or so. So the point is, the company's generating plenty of operating cash flow to cover their dividend. Then when I take a look at free cash flow, you also get to see a situation where free cash flow is likewise covering the majority of their dividend, or it's extremely well covered. Their dividend payout ratio of free cash flow is in the 30-40% range here more recently, 37, 29, 36. So it has ample operating cash flow and free cash flow to pay out their dividend. Let's look at it from the standpoint of EBITDA, earnings before interest, taxes, depreciation, and amortization. And let's go ahead and put price back on the graph now, because I think this is really important. This company trades at a discount to its EBITDA valuation. Here we've got an EBITDA fair value calculation of 15, but I want you to notice, looking at the long-term normal price to EBITDA, it has averaged about 8.3, and the company currently trades at a price to EBIT of 9.2. What I'm really showing you here is you're looking at a company who's currently trading just a little premium to its normal price to EBITDA over this time frame. So no matter how you measure Stanley Black & Decker, it looks reasonably priced today. So let's look at some other methods. Finish this video by looking at forecasting a little bit, because we can evaluate the past, but we can only invest in the future. So let's look at what expectations are for growth going forward. There are 20 analysts who believe the company is going to grow, and I've gone back to estimated earnings here, or adjusted operating earnings, by 12.89% this year, and then 12.96% next year. And then we lose the majority of those analysts, and we have 8 analysts forecasting about 9.26% and then down to 2. So I tend to put more credence on these 2 estimates right here. And when I look at the company's earnings scorecard, how accurate the analysts have been historically, and the record's good. They have missed 20% of the time, but otherwise they've hit approximately 80% of the time, both when analysts were making a 1-year forward estimate, and that's with a 10% margin of error, or a 2-year forward estimate. So these estimates are liable to be reasonably accurate. Now, when I apply the normal multiple, which is that slightly higher PE that the market affords, now we start to see Stanley Black & Decker looking reasonably valued at these levels. And if we hit these estimates going out a year and a half or 2 here, we see that we have the opportunity to make double-digit returns, 13.37 if it were to trade at that 17 PE. The next, by the end of fiscal year 2019, the average annualized rate of return could be about 15%, or a gross capital appreciation of 20% plus dividends. But the point is, there are opportunities. Now, I can also look at other normal PE ratios here, and I can use a more conservative 16 normal PE, and I'm still starting to approach double-digit rates of return out here based on these consensus estimates. So I think Stanley Black & Decker is a very attractive investment right now, but it's not, well, I'd say it's a fairly valued investment right now, maybe slightly overvalued. Probably the best thing to do would be to wait for it to, get down in closer to a 15 PE if you're willing to do that. But when you look at the company, it's A-rated, only has 23% debt to capital. Again, it's a dividend aristocrat. It only offers a 2% current yield, but it does offer some capital appreciation. But if you're able to buy this stock a little cheaper, it would even be better. Anyway, this has been Chuck Carnevale saying thanks for watching. As the co-founder of FastGraphs, the Fundamentals Analyzer software tool, any viewer that's interested in learning more can either call us at this number, 813-960-9600, or log on to fastgraphs.com and try a free trial of the FastGraphs research tool, where you can conduct your own research on stocks like this. This has been Chuck Carnevale saying thanks for watching.